copper market just experienced something we haven't seen in over a decade, and the implications are staggering. While everyone's focused on gold and silver, copper quietly hit a critical inflection point that's about to reshape global commodity markets. Current prices, as I'm recording this, copper futures trading at $4.87 per pound, up 2.3% on the session. London Metal Exchange, 3-month copper at $10,720 per metric ton. Shanghai Futures Exchange copper at 88,450 yuan per ton. That's a $340 premium to London, representing a 3.2% arbitrage. That premium tells you everything about where real demand is coming from. Asian buyers are paying significantly more than Western spot markets, and that spread is widening. Let me show you what happened over the past 72 hours that nobody's talking about. Global copper inventories tracked by exchanges hit a 7-year low. LME warehouse stocks dropped to 87,000 metric tons, the lowest level since March 2018. Shanghai exchange inventories fell to 194,000 tons, down 62% from this time last year. COMEX inventories sitting at just 31,000 tons. Total visible inventory across all 3 major exchanges is 312,000 metric tons. To put that in perspective, global copper consumption runs approximately 25 million metric tons annually. That's roughly 2.1 million tons per month. Current exchange inventories represent less than 5 days of global consumption. 5 days. Let that sink in. The copper market is running on fumes, and nobody in mainstream financial media is sounding the alarm. Now, here's where it gets interesting. Chile's Codelco, the world's largest copper producer, just announced production will decline by 8% this year due to ore grade deterioration at their legacy mines. Peru's Southern Copper warned that environmental regulations and community protests are delaying expansion projects that were supposed to add 400,000 tons of annual capacity. Zambia and Democratic Republic of Congo, which together account for nearly 15% of global mined copper, are dealing with power shortages that have forced multiple mines to operate at reduced capacity. Indonesia just extended its export ban on copper concentrate, forcing more domestic smelting but creating bottlenecks in refined copper output. The supply side is fracturing while demand continues accelerating. Electric vehicles require 4 times more copper than traditional combustion engine vehicles. A single EV uses approximately 183 pounds of copper compared to 48 pounds in a conventional car. Global EV sales hit 14.2 million units last year and are projected to reach 18.5 million this year. That's an additional 2.6 million tons of copper demand from EVs alone, and we haven't even factored in charging infrastructure, grid upgrades, or renewable energy installations. Solar installations require approximately 5.5 tons of copper per megawatt of capacity. Wind turbines require 4.7 tons per megawatt. The International Energy Agency projects renewable capacity additions of 570 gigawatts this year globally. That translates to roughly 2.9 million additional tons of copper demand just from renewable energy infrastructure. Add it up. EVs driving 2.6 million tons of incremental demand. Renewables adding 2.9 million tons. Traditional infrastructure and industrial demand holding steady at approximately 18 million tons. Total projected demand for this year sits around 26.4 million tons. Mined supply is projected at 24.1 million tons after accounting for production disruptions in Chile, Peru, and Africa. That's a 2.3 million ton deficit, the largest supply deficit in modern copper market history. And exchange inventories are sitting at 5 days of consumption. You see the problem. This isn't a temporary imbalance. This is a structural crisis that's been building for years and is now reaching critical mass. The market has been drawing down inventories to fill the gap between supply and demand, but we're running out of inventory to draw from. When inventories hit 0, there's no buffer left. Price becomes the only mechanism to ration supply. Now let's talk about what's happening in China, because that's where the real story is unfolding. China accounts for 54% of global refined copper consumption. Their Lunar New Year holiday just ended, and factories are ramping back up. Copper imports in January hit 527,000 tons, up 18% year over year despite higher prices. The State Grid Corporation of China, which manages the world's largest power grid, announced plans to invest $140 billion in grid infrastructure this year, a 22% increase from last year. That's massive copper demand coming online. China's property sector, which traditionally accounts for 30% of Chinese copper demand, showed signs of stabilization last month. New construction starts were down only 3% year over year, compared to double-digit declines throughout most of last year. If Chinese property demand even flattens rather than continuing to decline, that removes a significant bearish weight that's been suppressing copper prices for the past 2 years. Meanwhile, China's State Reserve Bureau has been quietly accumulating copper. Official data shows they haven't made purchases, but bonded warehouse stocks in Shanghai have been declining steadily even as imports remain strong. Where's that metal going? Strategic reserves that don't show up in official statistics. The same playbook they used with rare earths and other critical materials. They're building strategic buffers, while Western nations are just waking up to supply chain vulnerabilities. Speaking of Western nations, the United States just designated copper as a critical mineral under the Defense Production Act. That classification allows the government to incentivize domestic production, streamline permitting, and potentially establish stockpiles. The problem is, there are no shovel-ready copper projects in the United States. The last major copper mine to come online was Resolution Copper in Arizona, and that project has been mired in regulatory delays for over a decade. Even if permitting was fast-tracked tomorrow, it takes 7 to 10 years minimum to bring a major copper mine into production. The supply deficit isn't getting fixed anytime soon. Europe is facing a similar predicament. The European Union's Green Deal and electrification targets require massive amounts of copper, but domestic production is minimal and declining. They're entirely dependent on imports at a time when exporting nations are prioritizing domestic supply security. Resource nationalism is rising globally. Countries that produce raw materials are increasingly reluctant to export them when they can add value domestically through processing and manufacturing. Let's look at the technical setup because the chart is telling us something critical. Copper tested the $4.50 support level 3 times over the past 6 months and held each time. That's a triple bottom formation, one of the most reliable bullish reversal patterns in technical analysis. We broke above the 200-day moving average at $4.68 and haven't looked back. The 50-day moving average just crossed above the 200-day moving average, a golden cross that typically signals sustained upside momentum. Volume on the breakout was 40% above the 30-day average, confirming institutional participation. Open interest in copper futures increased by 12,000 contracts over the past 2 weeks, indicating new money entering long positions, not just short covering. The weekly chart shows a clear cup and handle pattern with a measured move target of $5.85 per pound. That's 20% above current levels and represents a breakout to multi-year highs. The monthly chart is even more compelling. We're consolidating just below the 2022 highs of $5.04 per pound. A confirmed break above that level opens the door to retest the all-time highs near $5.80 from 2011. Adjusted for inflation, those 2011 highs would be equivalent to $8.10 in today's dollars. We're not even close to historical peak valuations in real terms. Now here's what most analysts are missing. The copper options market is pricing in significantly higher volatility over the next 90 days. Implied volatility on at-the-money call options spiked to 38%, compared to a 1-year average of 24%. That's options traders pricing in a high probability of a major move higher. The put-call ratio on copper options dropped to 0.62, the lowest level in 18 months. More calls being bought than puts indicates bullish positioning among sophisticated traders who use options for directional bets. Dark pool activity in copper mining stocks has surged over the past 3 weeks. Large block trades in Freeport-McMoRan, Southern Copper, and Teck Resources suggest institutional accumulation ahead of a potential breakout. These are the signals that precede major moves in commodity markets. Smart money positioning. Before the headline, news catches up to the fundamental reality. The narrative is starting to shift. Goldman Sachs revised their copper price forecast to $11,000 per ton for the second half of this year, citing supply constraints and accelerating energy transition demand. That's $4.99 per pound, above current levels, but still conservative given the structural deficit we're facing. Bank of America went further, projecting copper could reach $12,500 per ton by year-end if the supply deficit persists. That's $5.67 per pound, approaching those 2022 highs. Citigroup published a note last week warning that copper inventories could hit zero by the third quarter if demand continues at current pace and supply disruptions worsen. They use the phrase critical shortage in their report. When major investment banks start using language like that, markets pay attention. Here's the part that keeps me up at night. The copper market is structurally different from other commodities in one critical way. There's no quick supply response mechanism. If oil prices spike, OPEC can open the taps and flood the market within weeks. If agricultural commodities surge, farmers can plant more acres the following season. Copper doesn't work that way. New mines take a decade to develop. Existing mines are dealing with declining ore grades and rising production costs. There's no strategic stockpile that can be released to ease shortages. Once inventories hit zero, the market goes into backwardation. Spot prices trade at a premium to futures prices because immediate supply is worth more than future delivery promises. We saw a preview of this in March when spot copper briefly traded at a $200 per ton premium to 3-month futures. That backwardation lasted only a few days before inventories were replenished through imports. But what happens when there are no more inventories to draw from anywhere? What happens when Shanghai, London, and New York are all at zero simultaneously? Price is the only variable that can adjust to ration supply. And in a market with perfectly inelastic supply meeting accelerating demand, price adjustments can be violent. We've seen this movie before. In 2006, copper inventories hit critically low levels and the price went parabolic, rallying from $2 per pound to $4 per pound in less than 6 months. That was before EVs existed, before the energy transition, before grid infrastructure became a national security priority. The demand drivers today are exponentially more powerful than they were in 2006. Let's talk about the investment implications, because this isn't just an academic exercise. Physical copper is difficult for retail investors to access. You can't store copper bars in a safe deposit box like gold or silver. Futures contracts require margin and management, unsuitable for most investors. That leaves copper mining stocks and ETFs as the primary vehicles for gaining exposure. The largest copper ETF trades under the ticker CPER. It's a futures-based product that tracks copper prices, but suffers from roll costs in contango markets. Better to focus on mining companies that benefit from rising copper prices without the drag of futures roll costs. Freeport-McMoRan is the largest publicly traded copper producer with operations in the Americas and Indonesia. They're a pure play on copper prices with minimal byproduct credits from gold and molybdenum. Southern Copper operates mines in Peru and Mexico with some of the lowest production costs in the industry. Their balance sheet is fortress-level strong, and they pay a consistent dividend. Teck Resources is a diversified miner with significant copper exposure from their operations in Chile and Canada. They're in the process of spinning off their coal business to become a pure metals company focused on copper and zinc. These companies have operating leverage to copper prices. When copper moves 10%, their earnings can move 40% or more because fixed costs are already covered and incremental revenue flows directly to the bottom line. At current copper prices, around $4.87 per pound, these companies are generating strong cash flow. If copper moves to $5.50 or $6 per pound as supply deficits intensify, their earnings will explode higher. But here's the risk nobody wants to talk about. What if I'm wrong about the supply deficit? What if recession fears materialize and industrial demand collapses faster than EV and renewable demand can compensate? Copper is often called Dr. Copper because of its reputation for predicting economic health. It has a PhD in economics because it's used in so many industrial applications that its price reflects real economic activity, not just speculation. Recent weakness in Chinese manufacturing PMI and concerns about U.S. consumer spending have some analysts worried that we're heading into a demand slowdown. If recession hits hard, copper demand could drop 10% or more, easily overwhelming the supply deficit and sending prices lower. Inventory builds would resume, and the backwardation scenario I outlined wouldn't materialize. That's a real risk, and anyone considering copper exposure needs to factor it into their decision-making. The other risk is policy response. If copper prices surge and create bottlenecks in the energy transition, governments could intervene. Export controls, windfall taxes on mining companies, price caps, strategic stockpile releases from hidden reserves. All of these are potential bearish interventions that could cap upside. China, in particular, has a history of intervening in commodity markets when prices rise too quickly. They have released strategic reserves of copper, aluminum, and zinc multiple times over the past decade to cool overheated markets. If copper rallies to $6 or $7 per pound, expect Chinese authorities to flood the market from state reserves to bring prices back down. Despite these risks, the structural case for higher copper prices remains compelling. The supply deficit is real and growing. Inventories are at multi-year lows with no clear path to replenishment. Demand from energy transition technologies is accelerating faster than even bullish forecasts predicted 2 years ago. Mine supply growth is stagnant and facing increasing headwinds from ore grade decline, regulatory challenges, and resource nationalism. The setup feels similar to 2006, but with more powerful demand drivers and less responsive supply. If you're looking for a commodity with structural tailwinds, copper checks every box. The current price, around $4.87 per pound, represents value relative to where fundamentals suggest we should be trading. A move to $5.50 or $6 per pound over the next 12 months is not only possible, but likely if current trends continue. The question isn't whether copper goes higher, it's how fast and how far. The timeline matters for traders, but not for long-term investors who recognize that the energy transition requires massive amounts of copper and there isn't enough supply to meet that demand. Position accordingly. Understand the risks. Recognize that short-term volatility is possible, but long-term trends favor significantly higher prices. Don't follow anyone blindly. Do your own research. Understand what you own and why you own it. The copper market is at an inflection point. The moves we see over the next 90 days will likely set the tone for the rest of the year. Trade with logic, not emotion. The story is just getting started.